I actually thought this was crazy when I read this out loud, but 180,000 rental units are about to flood Canada in 2026. That's a 7% increase in rental supply happening right now. And if you're one of 1.15 million Canadians about to renew your mortgage this year, or you're trying to figure out whether it makes more sense to rent or to buy, I personally think this changes everything for you because nobody's really connecting the fact that the biggest rental supply surge in over 30 years is hitting at the exact same time as the biggest renewal wave in Canadian history. And to me, the timing is not really a coincidence. It's going to determine whether you make or lose up to $50,000 in the next 3 years alone. So here's what I'm going to cover today. Why did vacancy rates just hit 3.7% in Vancouver, which is the highest since 1994, and what the rental flood actually does to home prices? The decision framework that you need right now if you're renewing at $560 more per month, or you're trying to figure out whether or not you're trying to buy this year. Let's break it down. All right. First, because everyone wants it, the data. And I'm pulling this from CMHC's 2025 rental market report that just came out in December of 2025. So it's literally only a few weeks old. And this is the most current content available in 2026. Here's the numbers that you need to know. National vacancy rates at 3.1% in October of 2025. That's up 2.2% from just over a year ago. The 3.1%, honestly, it might not sound dramatic, but context is everything. We haven't seen a national vacancy rate above 3% since 2021, 2020 during the pandemic when not a single soul would move because nothing was freaking available. But here's where it gets interesting. And I always try to look at things from a regional context because Canada isn't one national market, it's a regional market. Vancouver itself had a 3.7% vacancy rate, which doubled from 1.6% just over a year ago. And according to BC's housing minister, this is the highest they've seen in 30 years since 94. That's crazy. Since the Canucks, I guess the second time the Canucks lost the Stanley Cup. Oh, you can say, or didn't win it. Whatever. First riot. Toronto is up 3% from 1.8. First time above 3% since the pandemic. And Calgary's 5.7 vacancy is wild because it was like 1.4% in 2023. Calgary went from crisis level shortage to oversupply in only 2 years. That's freaking nuts. Now, nationally, vacancy climbed 40% faster than demand in the marketplace. Not a typo, 40% faster than demand in the marketplace. And the supply of vacant units grew 40% faster than the amount of people looking to rent houses. So the question you're probably wondering is why the frick is this happening? Why does it mean to me? So 180,000 purpose-built rental units are under construction right now today. That's enough to increase Canada's entire rental stock by 7% as they complete basically for the most part in 2026. And the crazy part about this is that in Q3 25, so fall of 25, build to rent starts surpassed condos and house starts. They combined for the first time ever in Canadian history. We'll repeat that one more time. Build to rent starts surpassed condo and housing starts combined for the first time ever in Canadian history. Let that sink in for a quick second. Developers completely changed their purchases. They went from pre-construction sales. Those dropped, as you know, in Toronto, ain't nobody buying them. They were down 90%. Sales dropped 20,000 units in 2022 to 1,900 in 2025. So developers just said, screw it. We're going to start building rental properties. And I've personally seen it across the board. And a big reason for this is because most of these rental projects got federal subsidies through CMHC's multi-unit program. If you're not familiar, we can get into that in another episode. But essentially what it does, Select offers low-cost loans. It reduces the insurance cost, GST exemptions, and essentially the government is pushing developers to build rental properties. Now, the second reason this is happening is big part is the immigration cuts. As you guys know, recently Canada cut significantly the amount of people letting in the country. Just back in 2023, they let in 1.27 million people, and that was the most since 1957. And then in 2024, the government basically they closed the door and they turned it down from 500,000 to 395,000 permanent residents and 1.3 million temp residents, international students, and foreign workers were expected to leave the country by the end of 2025. So you've got record supply completing, and the tenant pool just fell off a cliff, which means that landlords are essentially competing for tenants for the first time in 5 years. Now, this isn't everywhere in every property, but in general, it is happening. They're offering a month of free rent, free allowances, parking, utilities, and in Toronto, it's crazy. They've had properties sitting for 60 plus days. That hasn't happened since 2022, 2023. So here's the question that people are asking from this. Okay, great, more rental supply. So what? How does that even affect me if I'm trying to buy, or if I own, or if I'm renewing? And that's what we need to get into. So the rental market and the home ownership market aren't completely separated, as you probably know. They are connected. And what happens right now is going to impact home prices in certain ways that maybe some people are not expecting. Now, here's where things get interesting and, in my opinion, counterintuitive. Most people think more rental supply equals lower rents, equals more people keep renting, equals fewer buyers and home prices drop. And in general, I would say that logic kind of makes sense, but it's incomplete. And it's because there's different mechanisms at play that pull in opposite directions. Like, think about it like this. Number one, the rental parity breaks down pressure on condo prices. So what I mean is, let's say you're in Toronto and you got a 2-bedroom condo. The rent's $2,400, which is down from $2,900 in the peak in 2022. So let's say you buy that same condo for $600,000. You put 10% down, that's $60,000, and at a mortgage rate of just under 4%. Let's say a $540,000 mortgage, payments are around $2,800 plus condo fees, $400. Miscellaneous taxes and expenses, you're probably sitting around $3,200 or in and around that place. So if you're paying $800 per month to own versus rent, that's $9,600 per year. Now in 2022, that math was reversed because rates were lower and rents were higher. Mortgage was $2,100. It was cheaper to own, so people were buying. But today, you literally have to pay a premium to own. And for a first-time home buyer looking at that math, I mean, they're thinking, why the do I buy in this market today? Here's the thing. The result of that is that you see fewer buyers buying condos, which is putting downward pressure on those condo prices. And we're already seeing it. In Toronto specifically, Toronto condo prices are down 16.5%. Vancouver's down 9%. And they're not houses. These are condos, specifically in certain areas, and starter properties where rental parity does matter for the most part. Now, on the flip side to that is 70% of Toronto rental condos are negative cash flowing right now. So you've got an investor who bought in 2020, they bought at $550, they got a mortgage of 1.99%, payments were $2,121, and they collected, let's say, $2,400 rent. Maybe they were up a few bucks a month, $100 or $200, but they were up nonetheless. That investor is now renewing in 2026, and let's just say they're just renewing their mortgage. The payments go up by about $600. Rent may have dropped down to $2,400 or just remains the same at $2,400, which means with the new payment around $2,800, they're actually losing now $400 per month or potentially more if that strata fee has gone up. And what's worse, if condo prices drop another 5 to 7% in 2026 or 27, which RBC is forecasting, that's another $30,000 to $40,000 in equity loss. So the question is, like, what are investors going to do about this? Well, they're going to sell, or at least they're not buying new investment properties, or at least in those areas. Now, it gets a little bit more complicated. On one hand, there are fewer investor buyers, which means less competition, which is actually good for first-time home buyers. But on the other hand, investors were providing support for the market. They were the marginal buyers that were keeping things from slowing down and dropping prices. And if you remove them, it puts more downward pressure on those condos, especially in Toronto and Vancouver. So let's swing this together. What does this all freaking mean? The net effect is that in short term, 26, 27, the condo market's probably going to fall another 5 to 10% in areas like Toronto and areas like Vancouver. I think the rental parity, the breakdown, it's cheaper to rent than own right now, and people probably see that. You probably see an investor exodus because they're losing money every month and they decide to list these properties. Obviously, higher inventory because they can't sell the pre-construction. But, and this part is critical, this is almost entirely a condo story in specific areas. Single-family homes have been much less affected because the rental supply surge is in apartments and condos and not in houses. Yes, I get it. There's outliers in some suburban areas. There are outliers, okay? But if you're buying a single-family detached home in many of the suburbs, the rental market dynamics, they don't really touch you. And the stats are showing that. And so this is the big question. This is the $100,000 question, in my opinion. The answer depends on something most people aren't paying attention to, which is how long this rental supply surge lasts. Because if it's temporary, then obviously waiting can cost you a lot more money than buying in this type of a market. So here's the thing that nobody's actually talking about when it comes to the rental supply surge. And it's fascinating, in my opinion. The rental supply flood is already coming to a kind of an end in some areas. Let me explain with the data that I'm seeing here. So for those 180,000 units under construction, they're completing through 2027. That's the wave that's hitting the market like right now. And that's why we're seeing vacancy rates actually increase nationally, higher in all markets. But here's the thing. We're seeing new starts actually already come down. They're tumbling across the board. Calgary had a rental supply or a record supply of new properties coming to the market in 24 and 25, which is expected to be pretty moderate in 26 because developers are getting really cautious. And that's because vacancy is going up. They're going to sit on these units for months right now, and some are offering 2 months free. So you combine that with Toronto, and we're seeing a further decline in the marketplace with the lowest amount of starts that we've seen since 2025, which also includes rentals. And in Vancouver, same thing, another decline with total starts looking to come down all the way until 2027. So what's happening right now is that supply that's completing right now was approved and started 2-3 years ago when there was a massive shortage. But the developers looking at the market right now are saying, wait, let's hold on. Vacancies at 3 to 5%. Why the heck would we start a new project? And they're not starting new projects. The project starts are declining across the board. I mean, the amount of people that have told me about projects that actually have gone canceled is wild, let alone the ones that have just been halted. So the timeline I think we're looking at right now is 26, 27. We do see rental supplies flood the market. The units that were started in 22 and 2024 they're completing now. 27 and 2028, we see supply additions slow down. There's less coming to the marketplace, but we still probably have some completions from 25 starts. 29 to 31, we see the supply crunch again. Okay. The pipeline might be empty, but immigration will get normalized, population growth will rebound, and then we're right back to where we started. Except for now, it's worse because we'll have lost 3 to 4 years of development. Okay. So why this matters for a buyer, because if you're thinking, I'll wait until supply kills prices, then I'll buy, you're probably playing a dangerous game. You're trying to catch what they call a falling knife, or you're trying to predict when the market turns around. And this isn't a call for everybody to go buy right now. It's just look out for this because it will eventually happen. Let's say you're buying a $650,000 condo today in Toronto, and if you wait, prices drop 7% by late 2026 or somewhere in the next year, I would say. That same condo may be about $603,000 and you save 46 grand. But in 2028 or 2029, when the rental supply dries up and immigration starts to rebound, a condo is now worth 700, maybe 725, assuming a 10% appreciation from the trough. You can argue those points as much as you like. I'd love to see it. But you just lost money on the waiting. Now, the reason I'm using this as an example, because we saw this happen actually a few times in the Vancouver market. Now, the idea of being able to predict this market, I mean, I'll give you a perfect example. In 2019, the market slowed down. Believe it or not, we were coming off of the foreign buyer rule changes, rates were increases. And then just pre-COVID, the market was actually starting to rebound. We had a month of a delay, and obviously nobody saw the rocket ship going off, but the market was already starting to come back up. So the timeline, or the delayed timeline, was literally only a year. It was 2019, which was a soft year before things were going to come back. Now, I'm not suggesting we see this big swing back in studio apartments or things of that nature, but as a general rule, habitable properties that people want to live in, they will eventually circle back when those dynamics take place. So the net, if you were to buy in, let's say, the end of 26 or mid 26, or depending on your city, you would have ended up saving a swing of, let's say, 46 grand on the price drop, and obviously lower rent during that time, versus the opportunity cost of waiting for 3-4 years and missing the market recovery. Now, this does give you a pretty big gap or window of buying, but it also helps you to understand the numbers based on waiting versus buying at a time that makes sense for you. But the principle here at the end of the day is irrelevant around timing. Even if I'm wrong and it's 27 or 28, it's not about me trying to be right. the idea that holds is that trying to time the bottom is really freaking hard, and missing the recovery can be really, really expensive. But it gets more important because if you're not a buyer and if you're a homeowner facing a renewal in 26, the rental flood can completely, it's going to create a whole bunch of different issues, right? And this is the part that actually shocked me the most when I was running the numbers around this. 1.15 million Canadians, as we know, are renewing according to the Bank of Canada. 60% of those renewals, that's like 690,000 people are going to face higher payments. And for the people that locked in on 5-year fixed rates, the payment shock is going to be pretty brutal. Based on some general math, if you bought in 2020, average home price was $607,000, 10% down. Your mortgage at, let's say, 1.4%, which was like the best rate available at that time, would be about $2,224. And if you're renewing right now in January, your mortgage balance should be about $465. We paid down 80 grand. The best renewal rate you get, let's say it's 3.94%. We've seen that around. Your new monthly payment is going to be about $2,800, which is $576 more per month, or almost $7,000 increase. Now, here's a question. If you're facing that $576 monthly increase and you own a condo in Toronto or Vancouver, should you sell or should you rent? Because remember, rent for comparable 2 bedrooms is $2,400. The big question actually over and above that is, could you sell, take your equity, rent for $2,400 and be better off in the next 2 to 3 years? That's a big question that people are starting to ask. Now, before we go too far, properties bought in 2020 have actually gone up in value for the most part and held their value since that time. But it's worth asking the question, if you're coming up later this year or next year, the same thing. So there's a scenario that if you bought a property for $607,000 in 2020, even with the downturn, it's still worth $600K today, maybe $650 at the peak. You sell the property, pay off the mortgage. Your net proceeds might be around $89,000. You take that $89,000 and you rent the comparable place for $2,400 a month. Look at the numbers, right? Your net cost, based on the $2,000 mortgage plus the fees, is $3,200. You're building up about $700 a month. It's about a $2,500 net cost. Whereas if you sold and you rented at $2,400 of rent, you'd have $89,000 equity in the bank. Let's just say generating $4,500 a year at 5%. Your net cost is $2,500 based on that 5% return. So you're $475 better off renting over 3 years, $17,000 of savings. But the part that most people miss in this conversation is that, one, you're missing out on the potential equity build if the property values increase sooner than that 3-year timeline, or just in general. And the mortgage pay down, obviously. So it's about $25,000 of mortgage pay down. There's potential equity, let's say $25,000, $30,000 if the market recovers by 5%. So unless you're certain for a fact that the market's going to rebound or not rebound in 3 years, then you're taking a risk either way. But my thoughts are this: you might want to consider this if you're in a pre-construction condo that's seriously underwater and you owe more than it's worth. You're bleeding cash every month and another payment's going to kick your ass and you're not going to be able to make your payments. If you genuinely believe that Vancouver and Toronto is dead and it's going to fall another 10 to 15% in the next 2 to 3 years, then it also makes sense. And if you're okay with the risk of being priced out, then if you're wrong and you're okay with that risk, then go for that. But if you're somebody who can't afford the new payment, like you can afford it, it's not going to be an issue to make that extra $500, or you're in a detached home, in my opinion, which isn't affected as much by the rental floods, or you're planning to stay, say, another 4 to 6 years, or you don't want to move in general or have to deal with moving and or dealing with a landlord, then you probably want to stay in that property. And look, I'm not saying to sell and rent. For most people, I don't know that that's the right move. But what I am saying is, if you're looking at the numbers, an extra $500 to $600 a month, and you feel financially squeezed, you need to at least run your scenarios, because the rental market today gives you an option that you haven't had in 5 years, which is the ability to rent for meaningfully less than owning in the short term. Now, that being said, there are ways around that where you can mitigate the monthly payments. Some people think it's crazy and not a good idea to increase your amortization, but if it means the ability to keep your house and not have to pay commissions and real estate fees and all the costs of selling and renting, we didn't really add that into the equation, and you should be looking at that factor as well. Now, if you're an investor right now, I think you really need to hear this. 70% of those Toronto rental condos are negative cash flow right now. 7 out of 10 are negative cash flow right now. The numbers are absolutely brutal. And if you look at where the numbers are at, fast forwarding in 2026 from a previous renewal, it could get even worse if rental rates were to drop or you lose your tenant, which means your cash flow could be like literally thousands of dollars a month. And it can get worse. The condo that you bought a few years ago, which is worth $50,000 today after a 15% price drop, is down in equity. So you're underwater on the property and you're underwater on cash flow. So because I get asked this question all the time, like, hey, I have this property coming up. Should I keep it or should I rent it? I kind of created a little bit of a decision tree around that. The question that you need to ask is, one, can you afford the thousands of dollars over the course of the next 3 years, hoping that 2029, the prices recover? So that's the first one. If the answer is maybe, then, if you have high income and maybe this is just the one property, then you might be okay. But if you have 2 or 3 of these properties and you're bleeding money, that won't be sustainable for the average person. If you're the sell now scenario says you lock in the money, get rid of your losses. But the problem with that is you're selling in a weak market with lots of competition and other people that are doing the exact same thing. The third scenario, which is maybe a run on number 2, which is that you sell now, take the loss, keep your money liquid, wait 2 to 3 years for the prices to bottom, or 24 months, or watch and buy back in at 400K instead of the 500K that you sell for today, or 450 instead of the 500,000, which could actually work for you because you're not bleeding every single month, especially if you believe in real estate in the long term. But the risk with that is that if you're wrong about the bottom, you're going to miss the recovery. And if you're a pessimist by nature, you'll never buy back in. You're just going to look at it as a negative and you'll never, ever do it again. But at scale, if you think about this, 70% of rental condos are negative cash flow investors exiting the market. They're not buying new investment properties. In some cases, they're just selling. And what it means for the market is that short term, it reduces buyer demand, which is prices falling further. Longer term, there are fewer investors in the marketplace, which means less rental supply in 29 and 31. Again, bad news for renters. Like, this is really the cycle. Investors are going to chase high rents. Rents are going to fall. Investors are going to exit. Supply dries up. Rents spike. Investors return, and rinse and repeat. This happens over and over and over again. So the bottom line, if you're an investor, if you can hold through the trough, you might be okay in 29 and 2030. If you can't afford to bleed cash for 3 years and waiting to re-enter might make more sense, then you might want to consider a sell-buy decision or just look at the number of the situation of a loss. But whatever you do, do not make an emotional decision. Run the actual numbers. I see way too many people that just literally do this based on emotion, actually don't run the numbers. Okay, so bringing it all together, here's what you actually need to do. I'm going to give you the framework based on where you're at today, because your situation depends on where you are at. If you're a first-time home buyer, you need to ask yourself, A, are you going to hold your home for at least 5 to 7 years? Because if the answer is yes, you can buy now or within the next 12 months. And yes, there might be a price drop in 2026, but by 2029, with the rental supply drying up, you'll wish you bought at 2026 prices. And the difference between buying at the rock bottom versus buying 1 year early might be $10,000, $20,000. The difference between waiting could be $50,000 to $100,000. If the answer is no, then, and you're not willing to wait or stay in a house for a long time, then do not take the risk. It doesn't make any sense. Just rent right now and wait until you're ready to be able to hold onto a piece of real estate. If you really, really, really want to try and wait to catch the bottom, the major markets like Vancouver, Toronto are the ones that are probably going to be the most weak over the course of the next 12 to 18 months. If you want stability, then you're probably better off to buy something that you can live in longer term, like a townhouse or a single family home in a detached type of market, which has a little bit less upside right now, but it is also way less downside. Now, if you're somebody who's renewing your mortgage, run that affordability test. Can you afford the new payment? We have a payment calculator on our website. If you go to my Instagram channel at The Mortgage Pug and you send me a DM, smart, I will send you a calculator so you can figure out what your payments are. And if you do have payments that are much higher and you're going to have to dig into your credit, you might need to extend your amortization or look at debt consolidate options. There's multiple ways to do this, not just one. And the big question there when it comes to renewing, does selling and renting your property make financial sense for your numbers? I would say only if you're confident that prices are going to fall further and you're disciplined enough to set your money aside, invest it properly, and buy it back in. If you're borderline, run your numbers, run your scenarios, and do kind of like the diligence test before making that move. And if you're an investor, the big question realistically is, can you lose $10,000 to $15,000 over the next 3 years flat out? Is that something that you can actually do? If the answer is no, don't even bother in this market here right now. So the reality right now is, and this is the part that I think a lot of people need to hear, is we're in a weird moment in January 26th. The rental market's flooding, which is putting downward pressure on prices, but the flood is temporary. And the people who understand this, who buy in the trough, those people are going to probably do okay. Whether it's January or December of this year, there's going to be a period of people who buy and do really well. And, as somebody who's bought at this point now quite a few pieces of real estate and bought in multiple highs or lows markets, generally speaking, one of the things that I notice is that if you buy in these lows, even if it goes down a little bit, you feel pretty damn good in 3 to 5 years about that decision versus just like waiting and then having to catch on the way up because there's less inventory, more competition, all that kind of stuff. Either way, I'm not suggesting everybody buy in this market. I'm not suggesting everybody sell. The rental flood to the marketplace is really freaking real, and it's happening in January 26. Vacancy rates highest in 30 years. Rents are falling. Purpose-built rentals are coming, but it is temporary. In 29, we'll be back to some supply shortages, and we'll basically have another series of potential issues with property values recovering and or coming back. So what you should be watching for in the next 3 to 6 months, and this is key, I'll be tracking whether Vancouver or Toronto prices fall another 5 to 7%, how many investors actually exit the marketplace or end up renting their properties, and whether rental starts in Calgary or Edmonton continue declining. Those are the 3 things I'm paying attention to looking into the new year. And if you want to stay ahead of these things when it comes to real estate, make sure to hit that subscribe button on the podcast or the YouTube so you can stay up to date, because I'll continue talking to people about this. If you're renewing in 2026 and you want to know your options, I created a complete quiz to help you understand if you should look at fixed rates or variable rates, and a mechanism to understand how to approach your monthly payment differences. Just reply back on Instagram, prepare, that's PREPARE, and I'll send that over to you. My name is Alex and I'm with Flow, and my mission is to give you real data and information on Canadian mortgages, not just the bullshit everybody wants to spew, and not to scare you. I'll see you on the next one. Thank you for listening.